This is 86 million Americans, about a quarter of adults, sitting on a record $1.68 trillion in auto debt. Nearly a third are about to find themselves owed more than they are worth. It is a car payment trap, and unless you're already in, no one warns you. Data from the past 12 months suggests things are getting worse, not better. Let me show you how this trap closes. Why has it attracted more people than at any time in the last 32 years? Another number should prevent every car buyer from signing anything. Here is what is happening. The latest analysis of Century Fund and Borrower Protection, reported by CNBC in May, pegging the total US auto debt at the end of 2025 to $1.68 trillion. Compared with 2018, it increased by 37%. The average loan issuance balance climbed to $33,519 from $24,782 at the end of 2018. The average new car payment depends on whose data you trust. Experian earned $748 a month in the third quarter of 2025. Bank interest rate Q4 reported 767. Edmunds tracked Q4 reported 772. Whatever number you choose, ULLC monthly payments that didn't exist 10 years ago. That is where things start to get uncomfortable. Edmunds reported that in the first quarter of 2026, a fifth of new car purchase financing pays $1,000 or more a month. That is up from about 17% in the same period last year. Even for second-hand homes, 6.3% of buyers in the fourth quarter of 2025 pledged to pay four figures a month. It is also a record. So how did we land here? As early as 2018, the average transaction price of new cars fluctuated between $35,000 and $37,000. As of September 2025, the figure topped $50,000 for the first time. Ivan Drury, director of Edmunds Insights, told CNBC bluntly that it is a fluctuation of $12,000 to $14,000 in less than a decade, and revenue can keep up. Cheap cars have effectively disappeared. Sean Tucker of Kelley Blue Book told CNBC that in 2017, automakers have produced 36 models priced at $25,000 or less. Now, that number has plummeted to 4. Mr. Drury added that few new cars priced below $20,000 were available for sale. At the bottom of the market, no buyer has a choice. Prices have doubled and wages have not risen, but the industry continues to move metals. The answer is simple. It extended the loan. This is the first bite of the trap. An 84-month loan. Pay 7 years of depreciated assets. According to March 2019 data of Jingdong Electric Power, loans of 84 months and above accounted for only 7.3% of total sales. By the first quarter of 2026, Edmunds tracks that share, accounting for a record 22.9% of new car purchase financing. More than a fifth of new car buyers are now mired in loans that will not be repaid until 2033. Auto News' industry survey found that 64% of dealers said more than 3/4 of customers raised money within 72 months or more. That is why it is so important. A car lost the most in the first 2 or 3 years. But in an 84-month loan, you rarely cut principal in the same window. Literally, that number guarantees that millions of buyers will eventually owe more than the car's value. This brings us to the second mouth of the trap, negative assets underwater. The numbers are worrisome. Edmund found that in the first quarter of 2026, 30.9% of new car replacement transactions were negative assets. This is the highest share since the first quarter of 2021. This is a track 20.4% in 2023. In 2024 and the second quarter of 2025, it climbed to 24.9% and 26.6% respectively. It jumped to 28.1% in the third quarter and is now 30.9%. Nearly a third are struggling with loans. More people are underwater. More people are underwater. The average debt on the car's real value has climbed to $7,183. It was the second highest quarterly figure on record, up 42% in 5 years. At present, 26% of underwater cases involve more than $10,000 transferred to the next loan. Nearly a tenth, 9.3%, drag more than $15,000 in negative equity into new car purchases. Here are the details that few people talk about. Edmunds also found that the average age of underwater trading has climbed to 4.3 years. It is a record. People drag cars longer, hoping to close the gap. They remain mired in debt. That is how the trap closes around you. You bought a car you could barely afford with an 84-month loan. 3 or 4 years later, life changed, jobs changed, families changed. A transmission you didn't want to fix, so you replaced it. The problem is that you owe more than the car is worth. The dealer will help you transfer the negative balance to the next loan. You're financing your new car now, plus the remaining debt on your old car. Coupled with the additional terms of dealers, the renewal is 7 years, and the interest rate is higher. It is expensive. Edmunds reported that in the first quarter of 2026, negative equity buyers raised an average of $55,970. That is $12,071 more than the typical new car buyer. They paid an average of $932 a month, a record high above the market average of $159. The average AP for these loans was 7.9%, compared with 6.9% for all other loans. During the term of the loan, the buyer will pay interest of $15,663, compared with $9,592 in the market. That is about $6,000 in additional interest, just to drag old debt into your new car. 90.2% of negative equity loans have a maturity of 72 months or more. 43% lasted 84 months. By then, you'll really stop buying a car. You refinance for the last mistake longer. Gap insurance is a trap most people miss, and many buyers think it will save them. The policy covers the difference between your premium and your current loan balance, if the car totals. However, the standard gap usually does not include any negative assets previously transferred in. Many policies limit coverage to about 125% of the value of a car. Overall, a car carrying $10,000 is in debt. You can also buy a car you no longer own for thousands of dollars in cash. So what happens when people can't keep up? This is the third jaw, delinquent and withdrawn. Fitch data reported by Reuters and Marketplace showed that in October 2025, the proportion of subprime automobile borrowers overdue for at least 60 days climbed to 6.65%. It was the highest since the data series began in 1994, a 32-year high. The Federal Reserve's November 2025 Federal Register confirmed this. With the default rate of automobile loans rising in the third quarter of 2025, the pressure is concentrated on low-income borrowers, tenants, and non-prime credit ratings. Car delinquency among low-income census area households jumped about 70 basis points in a quarter, and recovery data from Cox Cars. The United States expects to recycle 1.73 million vehicles in 2024, an increase of 43% over 2022, the highest annual total since 2009. At the height of the financial crisis, 1.77 million cars returned to lenders. Cox's April 2025 forecast raised its 2025 forecast by 7% to about 1.82 million. Meanwhile, the Fed has been cutting interest rates. According to a report released by Cox Automotive, since the 30th of September 2025, the average interest rate of new car loans remained at 9.45%, while the interest rate of second-hand loans was 14.20%. Cox pointed out that the interest rate cut did not translate into lower borrowing costs for consumers. Edmunds' average real growth rate in April 2026 rose to 6.9% from 6.7% at the end of 2025. Borrowers with a credit score of less than 580. The Century Foundation and protected borrowers calculate interest rates above 18%. A $30,000 car alone pays about $14,000 in interest over 6 years. Who is most likely to be surprised by all this? Sean Tucker of Kelley Blue Book notes that more than 43% of new cars are now purchased by families with incomes of $150,000 or more. It is a record. The industry is effectively redesigned around high-income buyers. The Century Foundation found that the lowest-income borrowers, those earning less than $35,000 a year, pay an average of $738 a month on car loans. That is above the overall average of $680. Their loan balances averaged nearly $4,000 more than those of families earning more than $175,000. Angela Hanks, Director of Policy Programs at the Century Foundation, summarized the whole crisis to CNBC. People are seeing more and more wages being swallowed up by car payments, she said. How to really avoid this trap? The study kept going back to a few specific levers. The 20 divided by 4 divided by 10 rule that personal finance experts have cited for decades. Cut interest rates by 20%, no more than 4-year loans. The total cost of transportation is less than 10% of the total monthly revenue. Its interpretation is the opposite of what drove the crisis. Most buyers now pay close to zero for an 84-month contract. Cars alone account for 15 to 20% of its revenue. In the long run, the deeper the trap drags. Ivan Drury, like anyone in the CNBC report, made it clear that the longer the term of these loans, the harder it is to get rid of them. His next word, he warned, was to grab the whole thing. The extra money has to come from somewhere, he said. Maybe groceries, rent, savings, emergency funds. This is the car payment trap. It was a good decision. This is the doubling of price, the extension of term, and the disappearance of rights and interests. The bill quietly shifts from the dealership to your grocery budget, your rent and savings account. Nearly a third of underwater transactions. 1 in 5 new buyers pledged $1,000 a month. Subprime default rate hit a 32-year high. 1.73 million units were recovered in a single year. The trap is not on the road. It is already here. The only question left is whether you signed the document. It puts you in the middle.